What's going on YouTube? So in this video, I'm going to break down how to use the BRRRR method to buy your first 10 rental properties. So if you want to scale your rental portfolio fast, get paid along the way, and potentially receive an infinite return on investment on every single one of the properties that you purchase using the BRRRR method, definitely watch this video to the very end so that you could understand the concept behind the BRRRR method and how you could use it as a new real estate investor. Let's dive in. All right, so let's talk about the BRRRR method. So the BRRRR method is an acronym, and BRRRR stands for buy, rehab, rent, refinance, and repeat. So essentially in step number one, you're going to purchase a property, often one that needs repairs or is undervalued, ideally below market value. Then you're going to renovate and repair the property to increase the home's value and attract the right tenant to that property. Then you're going to find a tenant and start generating income. Then after the home is tenant occupied, you're going to perform a cash out refinance in order to pull out the equity that you created during the rehab process. Then the last step in the BRRRR method is to use those funds to buy another property and then rinse and repeat the process. So to better understand the BRRRR method, let's go ahead and put some numbers behind this specific strategy. So let's say for an example that you purchased a $100,000 property. That $100,000 property needed a little bit of work, so you put $30,000 into the rehab and renovation of that property. After you rehab the property and ordered an appraisal, the home's value increased to $180,000. So you purchased the property for $100,000, put $30,000 of work into it, so you're all in for $130,000. However, after the repairs and after the renovations and after the appraisal process, the new home's value is $180,000. So now your new home that you purchase is move-in ready, so you rent it out for $1,500 a month. After you find a tenant and start generating income, now you do a cash out refinance and you pull out up to 80% of your home's new value. 80% of $180,000 is going to be $144,000. This $144,000 is going to cover your purchase and rehab costs. So essentially, if you paid this house in cash and you use a home equity line of credit or a credit card, or you just use $30,000 in cash in order to rehabilitate this property, that $144,000 is going to go back to replenishing your reserves in your bank account or paying down any loans that you took out in order to acquire and rehab this property. And the difference of the $144,000 and $130,000 is going to essentially go into your pocket. Then you're going to repeat the process by using the same cash that you use on property number one, plus the extra that you receive during the refinance process in order to purchase your next deal. Now, this is great and all as far as a concept, but one question that I always get asked is why refinance and take out a loan on the property? Now let's go ahead and talk about that right now. So the answer to the question, why refinance and take out a loan, is because you get a better return on investment if you use the BRRRR method versus a straight purchase. So let's go ahead and break down those numbers right now so that you have a full understanding of why the BRRRR method works and how you get to receive a better return on investment. So again, option A is going to be a straight purchase. So you buy for $100,000, rehab it for $30,000. Now you're all in for $130,000. The rents that you receive from this property after it's tenant occupied is going to be $1,500 or $18,000 per year. That's minus property taxes and homeowner's insurance at $200 a month or $2,400 per year. Now your projected net income from this property is going to be $15,600. The way that we arrived at this number is going to be $18,000 minus $2,400 for taxes and insurance. Now, if we calculate our cash on cash return on investment for this specific property, that leaves us with a return on investment of 12%. Now, if you're a new real estate investor, you might not know how to calculate cash on cash return on investment. So here's an equation to help you better understand how to calculate the cash on cash return on investment. So you're going to take your annual before tax cash flow, also known as your projected net income or your actual net income, and you're going to divide that by the total cash invested. So in this example, we're going to take $15,600 and we're going to divide that by $130,000, which is what we're all in for, which is going to be our total cash invested into this property. And that's going to give us a 12% return on investment. Now, a 12% return on investment on your very first property is not bad at all. However, you can get a better return on investment if you use the BRRRR method. So let's go over that right now. So again, if we purchased a house for $100,000, rehabbed it for $30,000, and we got a new appraisal on the property, which values the home at $180,000, we're going to cash out refinance up to 80% of the new home's value, which is going to be right here. And that refinance amount is going to be $144,000. Again, we're all in for $130,000. New loan amount is going to be $144,000. That leaves us with a cash out difference of $14,000 because we're going to be using $130,000 out of this $144,000 in order to pay back our loan or replenish our bank account that we used to purchase this property. Now, if you're interested in understanding what the mortgage payment is going to be on a $144,000 loan, I have that broken down right here. $144,000 loan, 30-year term, 7% interest rate. We have a principal and interest payment of $958. So our mortgage payments on this property is going to be $958, but we're renting this property out for $1,500 per month or $18,000 per year. Now let's go ahead and add our taxes and insurance, which we did right here at $100 for each, our property taxes and homeowners insurance. That gives us a total of $1,158 for our principal, interest, taxes, and insurance. By the way, if you're wondering why I didn't include a vacancy rate or potential repairs that's going to be needed on this property in the near future, and that's simply because this cash out right here amount of $14,000 is going to go into a piggy bank and going to be used as reserves, so we don't have to calculate CapEx as well as a vacancy rate on this specific property, which will help with our return on investment. Since those are potential problems that could happen in the future, but are not actual numbers and actual expenses on a monthly basis, that would obviously decrease our return on investment and that would skew our numbers not in our favor. So I like to use this cash out amount as a reserve in order to not add those expenses into the overall return on investment calculation. And on top of that, my primary strategy when it comes to rental property is going to be Section 8. And Section 8 has a longer than usual lifespan as far as tenant occupancy and lasting longer than 5, 7, 8 years. Now back to the numbers. So again, our principal, interest, taxes, and insurance is going to be $1,158 per month. And our net income off of this property is going to be $342 per month. That's going to be our rental income minus our principal and interest and our taxes and insurance, or $4,000 on an annual basis. Now, the great thing about the BRRRR method is you could potentially receive an infinite return on investment. Now, how so, you might be asking? The primary reason on why the BRRRR method is so powerful is, again, with the cash on cash return on investment calculation or formula, it's going to be cash flow divided by our total cash invested. Since we did the BRRRR method and our total all-in cost was $130,000, but we performed a cash out refinance on this property up to 80% LTV of the new value of this home, we get back $14,000. So essentially, the $4,000 that we'll be receiving in net income per year is divided by negative $14K, which gives us an infinite return because at the end of the day, we have no cash invested into the property. By performing the BRRRR method and value adding into a property just like this, we are receiving money at the end of the day. And the great thing about the cash out amount is cash out funds are non-taxable income because these are going to be the proceeds of a loan as opposed to generated income from the property. I hope this makes sense. If this doesn't make sense, do me a favor and comment below and let me know if you have any questions about the BRRRR method and how you could receive an infinite return on investment by using this specific strategy here. But I will be honest, in order for this to work, the value of the home needs to be below market value, which we will cover a little bit more in detail in a few seconds. So now that you understand the BRRRR method and how to receive an infinite return on investment, let's go over how you could scale to 10 properties using the BRRRR method. So step number 1 is to buy a property below market value. And this is going to be the key in purchasing a property and using the BRRRR method in order to receive compensation at the end of your refinance. And that's because we're doing a value add to the property and forcing the appreciation of the asset. And that's going to be very important. If you skip step number 1, then unfortunately, unfortunately, the BRRRR method won't work out in your favor in receiving a paycheck in the form of cash out proceeds, as well as receiving positive cash flow on a monthly basis that could potentially give you an infinite return on investment. Now, step number 2 in scaling to 10 properties is to rent out the house to service the debt. Now, the initial expenses off of the purchase of this real estate is going to be taxes and insurance, as well as your utilities. So you will have holding costs or operating costs on a monthly basis until you get this home rented out. Now, once the home is rented out, now your debt is serviced, your utilities are going to be transferred over to the tenant's name, and it's going to be much easier to get a loan once the home has rental income. Now, step number 3 is to refinance into a conventional loan and pull cash out. Now, the reason why we're going to want to use a conventional loan is because number 1, we're going to be able to leverage our ordinary income, so our 1099 income and or our W-2 income, as well as conventional loans are going to be the cheapest loans for real estate. Step number 4 is going to be recycle the funds and repeat the process. Now, this is great and all as far as a concept. However, there are common mistakes that new real estate investors make during this process. So let's go over some of those mistakes so that you can avoid losing money on your first real estate transaction. Now, the first mistake that new real estate investors make is overpaying for the property. Now, this is a very common mistake because we want to get into our first deal. However, if you overpay for the property, unfortunately, you won't be able to force the appreciation of that property and then capture some of the money that you invested into that property, because most lenders will only allow anywhere from 70 to 80% loan to value ratio of the new appraised value. So if you overpay for the property, then you're going to be very limited on the amount of funds that you can take out via a cash out refinance. Now, the second common mistake is overestimating the after repair value. Now, this goes along with mistake number 3. And the reason why most individuals overestimate the after repair value is because they're using the wrong comparable sales to determine the after repair value. What I mean by that is they're using the wrong property type, they're using the wrong zip code, they're using the wrong square footage, or they're using old listings that are not going to be relevant to the fair market rent for that specific time frame. So when understanding how to determine the after repair value, it needs to be like property type, in the same zip code, to be honest, in the same block, ideally, have similar square footage, plus or minus 250 square feet, and the listing must be current or have recently been sold. Mistake number 4 is underestimating rehab costs. Now, this also goes along with mistake number 5, which is going to be choosing a bad contractor. You could underestimate rehab costs because a bad contractor or a shady contractor gave you a bid below the actual cost in order to win your business. However, they do the whole bait and switch. They tell you it's going to cost $30,000, but in the end, it costs $50,000 so that they could earn your business and milk more money out of you. The 6th mistake is scaling too quickly. Now, the reason why you don't want to scale too quickly is because of servicing the debt. If you have multiple properties in the pipeline that haven't been rented out yet, however, you're on to your next 1 or 2 properties and you need to service that debt as well as the other previous properties, then we begin to over leverage ourselves and we get into a sticky situation where our cash flow is below our debt that needs to be serviced on a monthly basis. So don't scale too quickly. Make sure that you rent the property out, then refinance so that you can service the debt, and then repeat the process after you receive money in hand. Now, the 7th common mistake is not knowing lender guidelines. For instance, if you want to refinance into a conventional loan, however, you do not have the paper trail or you do not have the FICO score in order to support a cash out refinance, then you're going to be in a sticky situation where you're ready to refinance, but you cannot because you do not meet the guidelines for that specific loan program. And the final mistake is going to be not having an exit strategy. Now, an exit strategy is going to be huge for your success as a real estate investor. So plan accordingly and plan ahead of time as opposed to going along with the flow, especially if you're purchasing an asset that costs $100,000, $300,000, or $500,000. Now, these common mistakes to avoid as a new real estate investor and using the BRRRR method could be its own separate video. So if you want me to go over more of the common mistakes that real estate investors like you and I make on a daily basis, and you want me to create a separate video about that, do me a favor and comment the word mistakes mistakes in the comment section below so I can know to make a video about these 8 common mistakes and more so that you could avoid losing money on your first or next deal. So as you can see, the BRRRR method in real estate investing is going to be a very powerful strategy. Not only are you going to be able to acquire a property under value, but also you're going to be able to force depreciation, receive compensation for it via a cash out refinance, as long as you meet the lender guidelines, and potentially receive a positive cash flow that could result in an infinite return on investment. Now, my name is Art Smith. I'm a mortgage loan originator and real estate investor. So if you have any questions as far as real estate investing, do me a favor and drop your questions in the comment section below. If you haven't done so already, do me a favor and subscribe to this channel. I am looking for more subscribers, and I also am looking for more thumbs up. So if you found value in this video, do me a favor and smash that thumbs up so that YouTube knows that this is really good content and it can be shared and distributed to more people just like us. Now, I have a new community that's going to be opening up to new investors like us very, very soon. So if you want to learn how to buy your very first rental property and fund that rental property without using any of your own money, do me a favor and click the link in the description box below so you can find out more details about that community. Now, again, if you enjoyed this video and you want to learn more about real estate investing, how to acquire a property, how to fund it, definitely check out one of these videos right here.